As a trader, has this ever happened to you? You enter a high probability trade that you have a lot of confidence in, the trade starts working, but then it hits your stop loss, reverses from that exact location, and then hits your profit target. So now where you would have made $1,000 on this trade, you lost $500 even though your thesis was correct. In this video, I'm going to teach you how to stop this from ever happening to you again by understanding liquidity. I'll break down the 3 different types of liquidity you need to understand, and then I'll show you real examples on the chart using these concepts so you can increase your win rate and become profitable. So in today's video, we're going to talk about the 3 most important liquidity concepts that you need to understand to become a profitable trader. Now, in this video, we're going to start off with the basic liquidity first, then we'll go to intermediate, and finally we'll go to advanced. The basic liquidity will be support and resistance liquidity, then we'll talk about pattern liquidity, and finally we'll talk about fake out liquidity. The fake out liquidity is the exact example that you saw in the introduction, and we're going to talk about how we can avoid fake out liquidity and place our stop loss in the right area to actually make sure that we capture that big move to our profit target. Now, with this video, we're going to start off basic, but do not worry, once we get to the advanced concepts, you'll see that every single one of these concepts build upon each other. So the first type of liquidity we'll talk about is support and resistance liquidity. This happens when the highs and lows will be equal and the price will use these levels to build up liquidity around these key areas. So in this example here, we can see we have resistance up here and we have support down here. Now, in between this resistance and support, what happened? Every time price came into this area, it was able to hold and come back into support. Every time we came back into support, we went back up to resistance. And finally, when we went to resistance, we came back into support. And this shows us every single time we came into that resistance area, sellers were overpowering buyers, meaning that there was more sell orders near this area than buy orders. And vice versa, every single time we came into the support area, there was more buying pressure than selling pressure. This shows that buyers want to hold the stock above this key area if we want to continue the trend to the upside. However, sellers also know this, and therefore they're trying to keep the stock below this resistance area if they want to reverse the stock to the downside. However, let's say at this resistance area, you take a short position, and when it comes down into that support, you don't take your profits because you believe that it will break support this time. But unfortunately, the stock moves back to the upside, and rather than holding this resistance, we actually break out of the resistance. What does this tell us? Well, this tells us that buyers are now more in control than sellers, even at this resistance area. Why? Because buyers were actually able to break above resistance after making that move into that support area. So when we're looking at a chart, what this should tell you is buyers needed to create this dip to add into their position to feel comfortable to actually break the stock out of resistance. Now, if you were in this short position, which wasn't a good trade, but we'll talk more about that when we get into the real examples, this is where you would have taken your stop loss. And I've seen a lot of traders try to take this type of trade where they take it short and then they don't take their stop loss and the stock starts moving back to the upside. So where they should have only lost $500, they end up losing $1,000 or more. But you have to understand, once buyers actually brought this stock above resistance, this resistance is not resistance anymore, but rather it turned into support. And if you've been watching this channel for a little while, you know that this resistance now turns into support. And this is the exact setup that I take, which is the break and retest. We broke above resistance and now we're coming back for that support retest. This is where I would have entered into that position, targeting either higher time frame levels or simply high of day for a continuation move back to the upside. So as we can see, when we break out of that resistance, the same thing happens up here that happened down here. We now create a brand new resistance. We also create these new support levels and once again, new resistance up here. Therefore, if buyers continue to break above these resistance levels, then we should be buying these resistance turn support retest for a continuation move back to the upside. Now, support and resistance liquidity is a little bit easier to understand, but let's talk about pattern liquidity or trendline liquidity. What is trendline liquidity? Well, trendline liquidity allows you to visualize levels of liquidity where the most buy and sell orders are placed on on the chart. Now, it's very important to mention, the stock market does not move because of trend lines. Just because you have a trend line and the stock breaks out of it, it's not breaking out of it because of the trend line. It's breaking out of it because of the buyers and sellers sitting near those liquidity areas. However, the trend line will help you visualize where those liquidity areas are. In this example here, we can see we have a high, another high, and finally followed by this last high up here. Now, when we see something like this, we can create a trend line or a line of best fit. In this example here, because we have these 3 points, we would draw that line of best fit. And this is where our resistance would be. This is where every single time that the stock came up, the sellers were trying to make sure that the stock does not break out, and they were trying to keep the stock below this level. However, when we do end up breaking out, you can see that this actually creates an impulsive move back to the upside because the sellers that were sitting here were trying to create that resistance again, but because buyers overpowered them in this area, they now had to get out of their short position, which creates even more demand for the stock. Now, with this being said, we do not enter into breakouts because I personally am not a breakout trader. So how would I take a potential trendline liquidity trade? Well, I would simply wait for this trend line, which is first resistance, to turn into support. As we can see, if we extend this trend line a little bit more, we created this high up here, which we can use for our profit target. But when we came into the support area again, this is where you would want to take your entry. The reason this is because when we come back into this area, buyers understand that they have to make sure this stock holds above this trend line. If it doesn't, and we come back into this area of consolidation, most likely this stock is just going to move back to the downside or low of day because buyers were not able to step up in this area. And this shows sellers that buyers won't be as aggressive, and therefore they'll take this signal as a strong short position and the stock will move back to the downside. So for me, I would wait for this retest of this trendline liquidity after the breakout, which shows that buyers are aggressively stepping in, and I would enter in as close to the trend line as possible, with my profit targets being simply high of day again or higher time frame areas of resistance. And finally, fake out liquidity. This is where you're going to lose money. Your stop loss is most likely in the wrong area when you do have fake out liquidity, and due to this, you are not in a high probability liquidity area. So when you enter your trade, the price will fail to hold the entry level that you have. So in this example here, what do we have? Well, we actually have this area down here as support. This is going to be that support and resistance liquidity that we saw earlier. We can see that once again, support was hit multiple times, and therefore we had that liquidity built up right at that support, and we broke above that resistance level, showing that when we were here, buyers were overpowering sellers. And because of this, especially what I said earlier, when we come back into this retest area, this is where you would try to take that long position again, with the resistance now turning support, and buyers need to hold the stock above this level. However, what does this stock do? Well, it actually breaks to the downside, it breaks that previous support, and it reverses from down here. Now, for you, you may think this is a random level that it's reversing from, but in reality, this is called a liquidity sweep or fake out liquidity, and you need to understand how this works to actually be a profitable trader and to know where to put your stop loss so you can capture those big moves on trades. Now, if this example doesn't make sense to you just yet, don't worry, we're going to be going over in-depth examples of every single liquidity concept that I just talked about. By the end of the video, you'll be able to identify liquidity just like a professional trader. So with this being said, let's go look at the real examples for all three different liquidity types, and we'll talk about exactly how you can implement this in your own trading so you can capture bigger trades. All right, so here we are for our first example. For the first example, we're going to talk about support and resistance liquidity. Now, this one is going to be very simple for you to understand, and I just want to make sure you can visualize how support and resistance liquidity plays out on a real chart and how you can enter to actually make profits. So in this example here, what do we see? Well, we have pre-market over here, and then we have intraday price action over here. In this example, we can see that we're creating a resistance up here and support down here. We can see that every time we came into these areas, we had resistance here, here, and here. And then when we came into the support area, we brought the stock back up. And once again, we're back into the support area, we're trying to bring the stock back up once again. So with this being said, what does this tell us? Well, from this area, we can see that buyers stepped in. We created a lower wick, which means that this candle at one point was at the lows, but buyers brought it right back up above this support area. And then we had an impulsive move back to the upside. Why? Well, it's just like I explained earlier. When buyers bought this stock up from here, they now had a little bit more confirmation that that support was holding, and therefore they brought the stock all the way back up into that pre-market high resistance. And as we can see, this was being used as resistance once again. At this resistance level, we can see that sellers were stepping in. This is that upper wick right here. We created a bearish candle and then we just consolidated through the day. Once again, we came back into this resistance. We created that upper wick, moved back to the downside, and we simply could not have a candle closure above this resistance, and we could not have a candle closure below this support. Like I talked about in my candle closure video, if you haven't watched it, you can watch that video after this video. It's very important to understand that so far this stock is consolidating and we needed to break either this resistance or the support before we enter the trade. Anything in this area is going to be a low probability trade. So with this being said, let's play out this trade and see exactly what happens. Here we can see we are finally getting a breakout below the support area. We are creating a brand new low of day and we got a candle closure below this level. What does this tell us? Well, this tells us that sellers are now more in control of price than buyers, and therefore because we broke this level, buyers did not aggressively step in, so we would be looking for a short position. Now, to look at a short position, just like I talked about, we now want the stock to move down, retest into this previous area of support, because now this support has turned into resistance and we would like a brand new low of day. So let's see if we can get that retest on this support level. So right here, as we can see, we not only broke below this support, but now we are retesting with a bearish candle. This candle right here shows that we had an upper wick, which means that buyers tried to bring the stock back above the support level or resistance now. However, sellers knew that they had to keep this as resistance, and sellers stepped in to ensure that the stock does not break above this support turned resistance. So I would look to enter into the trade here. My stop loss in this scenario would simply be this pivot structure high right here, because this is the level that if we come back above the support level, we need to hold as the last level of defense for the short side. And I need at least a 2R multiple. In this example, that 2R multiple comes around the 234 whole psych number. So this is a 2.08 risk to reward trade, meaning for every $100 of risk, we would make $200. Let's enter into a short position and see exactly what happens. So far, we are still below this pivot level. And just like that, we can see because we understood how simple support and resistance liquidity works, we were able to capture this move and make $530 in less than 10 minutes. So with this being said, this is the support and resistance liquidity, but now let's go over to pattern liquidity. All right, so here we are on an example on NQ. And on this example here, what do we see? Well, first we need context. And in context, we see that we had a really impulsive move to the downside. This shows that sellers are already in control of this chart, and therefore we should be looking for that position to the downside or a short position. However, how are we going to execute a short position? Well, in this example here, we actually have that pattern liquidity or trend line liquidity. As we can see, we want to draw the line of best fit, meaning where the most points hit. For this trade here, that would be one here, and one here. That's 3 points, and we can create that trend line that we know we need to break. Now, for myself, I am not trying to buy this trend line before it breaks, because there's a potential chance that it can move back up to highs. It's not as likely. However, there is a probability that it can move back up to highs, and it uses this as support for that push back to the upside. The only way I would take this trade is if we break to the downside, retest, and then move back to the downside, or look for this low of day pivot level. So with this being said, let's play out this trade and see exactly what happens. So as we can see, we broke below with an impulsive candle showing that sellers are aggressively trying to break this trend line. And now we are retesting. However, we are retesting with an upper wick, showing that sellers are now trying to hold this trend line for a move to the downside. So how would I play this trade? Well, I would enter into a short position once again, and my stop loss here would simply be the break of this pivot structure once again, the pivot structure that broke the trend line in the beginning, and my profit target here would simply be low of day. Now, this gives me a 3.37 risk to reward trade, meaning for every $100 of risk, we would be making $337. So let's enter into a short position here and see exactly what happens. So far, we came back into that pivot structure, but we did not break above. Therefore, we're still in this trade. We can see that we're also creating those lower highs as well. If you don't know how to read market structure, I have a full video on market structure as well. So far, we were actually creating support, which we ended up breaking as well. Therefore, this stock should now try to hold this support area back to the downside. As we can see, just like we said, this trade worked out by simply understanding liquidity. We made $4,745, and this was a simple trend line retest using simple liquidity concepts. Now, for the final example, we're going to talk about fake out liquidity, which is one of the most important liquidity concepts to actually learn. So let's go to the fake out liquidity example. So here we are on the fake out liquidity example. Now, there's going to be a couple ways that we can play fake out liquidity. My personal favorite is going to be the 84% rule if you're already in the trade. If you haven't watched the 84% rule video, I'm going to link a playlist in the description which has the 84% rule video in it. So make sure to watch that video after you're done watching this one. However, for this example, what do we see? Well, we see that we have a clear resistance level up here, and we see our last higher low was right here, which was our support level. Therefore, we know that this stock is now breaking to the downside. Now, because of this, a lot of people are going to be looking at this as a move to the downside, and they'll be looking for a short position because it broke this previous support. But what they don't understand is you have to always look left on the chart. Before this impulsive move, where did the buyers actually enter? In this example, the buyers were actually entering down here. As we can see, this is the lower wick that we created before an impulsive move to the upside. Like I talked about in the previous examples, every time we had an impulsive move to the upside, before that move, we always had either buyers accumulating the stock near demand or sellers accumulating near the resistance. In this example, we can see that because the buyers were actually aggressively stepping up here, so this fake out liquidity, this is where most retail traders would have put their stop loss, and now they're out of the trade. However, this is really the lowest risk entry that we would be looking for. However, we are not going to enter into this trade simply because it is at the lowest risk entry. We need to confirm that buyers are indeed stepping up, and this price action candle simply is not giving me enough information. So what I would be waiting for now is going to be a break back above this previous support level. If we can get a break above this support level, this shows that buyers are indeed stepping up. This is also the 84% rule, which once again, you can watch that video after this video if you haven't watched it. And therefore, all I need to see now is a strong price action candle above this support turned resistance. Because if we break back above this resistance, this will once again turn into support after coming back to where most of the buyers bought and after faking out most of the retail traders. So let's play out this trade and see what happens. So far, we can see that we've actually held that lower area, and now we're actually coming in for the retest. So as you can see, we broke above, and now we're retesting that exact same support level that we had before. So one thing I want you to notice, this here was all accumulation. Buyers and sellers were both coming in, they were accumulating the stock, and then we had this fake out liquidity. This is also referred to as manipulation. So you have accumulation over here, then you get the manipulation where retail actually stopped out of this trade. And finally, if you know accumulation and manipulation, the next move we should get is going to be distribution. I have a full video on accumulation, manipulation, and distribution moves itself. However, all this simply means is after the accumulation and manipulation, now the stock should distribute in the way that it was already heading before, which is an uptrend, and move back to the upside. So let's enter into a long position here. Our stop loss still has to be a break where buyers were first stepping in, and our profit target here is simply going to be this high of day level. This gives us a 2.7 risk to reward trade. Let's enter into a long position here and see exactly what happens. So far, as you can see, we actually consolidated and retested this exact support level as well, showing that buyers once again stepped up. So it's very important to remember, you need to see the proof that buyers are there, and you do that through price action. I have full in-depth price action guides as well on my channel. And just like that, we can see we actually created a brand new all-time highs. This trade resulted in $8,270, and this was simply by understanding fake out liquidity and how retail gets manipulated. Now, I want to remind you very quickly, next week, January 28th at 5 p.m. Eastern, I'll be releasing a full in-depth course on exactly how I would start day trading in 2025 to make my first $10,000 a month consistently. That video will come out next week at 5 p.m. Eastern. But other than that, if you got some value out of this video, make sure to leave it a like. If you have any questions, put them in the comments down below. Make sure to follow me on Instagram and Twitter and subscribe to the channel, and I'll see you guys next week with a brand new video.